Welcome to our webinar on debt restructuring. It's good to have you with us. For the next 45 minutes, we're going to bring you some insights from our experts who've had many years in this field. Whilst you're going to be on mute, we do encourage you to add questions to the chat. And after our discussion, we'll get to the questions. For context, Responsibility is a leading asset manager specializing in private markets in 3 investment themes: financial inclusion, climate finance, and sustainable food. We often work in emerging markets, which is why this topic is important. For now, let me hand you on to our moderator, Oleg Ivaniychuk, and he will introduce you to our panel today, and I'll come back in with questions. Thank you.
Many thanks, Rachel, and welcome to everybody. I think we have this exciting topic today, that restructuring in emerging markets, the area of specialization of impact asset manager responsibility. And the question is, of course, why this topic is important and why 3 of us are supposed to discuss it. And you know, when you provide private debt and your borrower goes into distressed situation, usually a lot of value gets destroyed. It is company can collapse, stakeholders, employees, clients of the company suffer a lot, and of course the value of your loan can diminish to 0. And that's why, of course, it's very important, if it comes to distress situation, to handle it properly, to provide structure, reduce uncertainty, reduce urgency, to provide the solutions for that. And why 3 of us are supposed to discuss this topic today? Let me introduce Richard Marney. Richard has 45 years of experience of banking in emerging markets, and I had the pleasure to work with Richard now for 10 years as Chief Risk Officer of Responsibility and now Senior Advisor to the Risk Management. And Richard is involved in different governance setups like investment committees, has several board seats in different institutions in emerging markets, and of course playing leading role in complex restructuring projects. And Richard has graduated from Johns Hopkins University. Tim Stubbs is our trusted partner on the legal side, has of course a different mindset, and currently he is partner at Dentons Europe, based in London. He had the pleasure to live and work in former Soviet Union for more than 30 years, and has been also working with responsibility now for more than 10 years on different restructuring projects on different continents. And he graduated from University of Michigan. And as of myself, I'm heading the restructuring team of responsibility, and that's why I also have the pleasure to moderate this panel with these two gentlemen. So we have also a poll for this webinar, where it's focused on the question: what do you believe is the biggest challenge to debt restructuring in emerging markets? And is it navigating the local institutional frameworks, understanding regulatory and policy prerequisites, managing the differences between emerging and advanced economies, of course, and applying insights from case studies to the real-world scenarios. So we would appreciate it also audience participation in this poll and take use of that. And actually, I mean, 3 years ago, you published your first book about debt restructuring in emerging markets, and it was like handbook for restructuring professionals, for lawyers, which was focused actually on process of restructuring and people, psychology. And now you're about to publish another book about debt restructuring in emerging markets, which I understand is focusing on slightly different area. It goes into the causes, fundamentals of restructuring, why it's happening. And if we pick up a little bit on this topic at very high level, what are the major challenges to successful restructuring? Maybe Richard, if you could elaborate on that.
Thank you, Oleg, very much. To frame the topic of why emerging markets, frontier markets restructurings can have more challenges, we can frame expectations, is the borrower redeemable? Secondly, are the stakeholders, borrowers, lenders, shareholders, etc., willing and able to work cooperatively towards a solution, whatever that might be? And third and last, does the institutional framework, the formal and informal rules that govern the economy, the financial sector, and the legal system, are they conducive? For all of the restructuring professionals on this call, they will recognize the first one is true of any restructuring, whether it's in France or in South Africa, whilst the second and third take on different aspects of intensity in the emerging markets. And in the process of, I began doing restructurings in the late 1970s when I went to Latin America, and what we discovered over time was that the institutional framework, the rule of law, the court systems, the governance at the corporate level, the efficacy of economic policy played a role not just in what causes the debt distress situation to arise, but also how they are restructured. And hence, when Tim and I began the series, which is now in its second book, we aim to focus in the second volume on what is the fundamental driver of differences, which we have been borrowing Douglas North's view of institutions. I think if any of you read his book in university, you know that his central statement was that the central puzzle of human history is to account for the widely divergent paths of historical change, and he elaborates over a very short but potent book on institutions. And so that was really the approach we took.
Mm-hmm. And then you're talking about this institutional framework, local institutional framework, also you're engaging into emerging markets versus advanced economies. And why are you highlighting particularly this local institutional framework?
Well, like many of you potentially on the call, you've done a credit training course, as we all did. And when we finished the course, the instructor left us with two statements, which he said, I want you to carry these through your professional life as a corporate finance lender. And the first was that the most compelling driver of debt distress is weak rule of law and its offspring. And then secondly, he said, if you don't trust the local court system of a country, don't invest in it. And so that is framed for us why that is important. Now in the book, what we've done is we've created a mind map, if you will, which takes institutions as they affect not just economic growth, financial stability, the vulnerability to crises, but also the drivers of defaults. And then once you're in a restructuring situation, the outcomes. And we are arguing that the weaker the institutions relevant to restructuring, as Jim can discuss later, all things being equal, the higher the loss given default. Mm-hmm. And in the book, as you'll see, we are going through a series of case studies to demonstrate that in real life. And again, I think Tim can go over that.
Sure. Well, because I think it's very interesting what you are saying, because it is rule of law and the court system and trust in the rule of law and the court system, of course, big challenge for most of the markets where responsibility is operating. And if you look at that, so Tim, what from your perspective as a lawyer, what was the most important elements of the institutional framework?
Well, I understand we only have 45 minutes today, so and usually as lawyers we get paid by the word. So paid by the word. So no, I'm not going to be able to answer that in full, but I'll make an effort at giving a bit. The simple answer is it depends. It depends on a lot of things. It depends upon the phase of the restructuring. Are you looking at the pre-restructuring phase, or are you looking at the restructuring decision for the case setup phase. These are the 5 phases that Richard and I outlined in our first book. But I think you also have to look at it a little more broadly in that which particular universe is going to be impacting on the case at any particular time. And I say universe because effectively in many emerging markets, you have parallel universes.
Yeah.
Norm talks about institutions being informal and formal. So let's remember that there may be a law on the books. And I remember this from years of explaining to clients about how Russian law or Ukrainian or Kazakh law, there may be the law on the books, but that law may actually operate entirely differently in real practice.
Yeah.
And there may be things like corruption in the courts. There may be predatory competitors, or there may be state capture. There may be any number of things that will impact on how debt will come into distress, how quickly it will come into distress, and then the manner in which you can resolve that stress. And so various institutions, let's take, for example, an FI borrower, right? SME lender. Which institutions are more, well, at the outset, you've got supervisory functions from the regulator, which are critical. And Richard lays that out in our chapter 2 of our second book. But you also have corporate governance at the firm level. And if the corporate governance is weak, and if the regulatory support is weak, then that's going to mix together to create disaster. So it really depends upon the particular phase and the manner in which that works. When you get to the decision-making and case setup stage, when you're looking at what your options are, the stress has already happened. Now you're looking at the options. You have to look at the emerging market insolvency framework. What are the rules? Are the 15 critical elements there that are going to support a formal restructuring? If they're not there, will you be able to get enough creditors around the table, including locals and internationals, to create creditor aggregation, which is going to give you support for a work out there? Do those players understand what Insol is and how it works and why you should be applying Insol, particularly in the emerging market?
And Tim, in the book, we have created a ranking or rating of what we'll call restructuring regimes. We borrowed from the famous movie, The Good, the Bad, and the Ugly. The good, which I think Singapore, Europe, United States, are where you both have the judicial and extrajudicial, which would be the consensual restructurings and Insol, not only in writing, but observed. And then the bad would be where you have them in writing, but they're not diligently followed. And then the ugly will be where you have neither. And I think people on the call, if you just take Insol, which we can take as a proxy for non-judicial restructurings, certain markets have them, certain don't. And the difference is market or the court system, where you have specialized insolvency courts, competent judges, and processes that stick to schedule. And then others where a bankruptcy may occur, you go into the court, a year later, you're still waiting.
But just add to that. You have to look at disconnect. This is one of the 15 elements of effective insolvency frameworks that we outline in chapter 11 of our book. What does the law say, and how is it applied in practice? And what's the disconnect between the law and people's willingness to accept and abide by the law? And that disconnect, and when the law has to be applied by the courts, by insolvency office holders, by the players, how well do those two universes work together? Is the law being applied in practice? Is it accepted by the players?
And then lastly, Oleg, as you're very well aware, is that if these challenges are understood when dealing with a particular jurisdiction, the benefit is not simply that you can navigate a restructuring better, but you can, at the beginning, when you are structuring your investment, put in provisions that will, if not avoid, at least mitigate the negative impact of these institutional what we call failures or inconsistencies.
Yeah, absolutely. Thank you, Richard. I think that you're touching on an important topic because this topic that restructuring in emerging markets, one of the what I have provided to optimize the value in distress situation, but of course, very important is of course the learning points from restructuring have to be played into the structuring of investments, considering the specifics of different markets. And I think you do really understand the specifica of different emerging markets when you went through distress situation. But then you have experience, is this rule of law, is there or not? Is it observed or not? And yeah. And maybe also, because you are referring also in the book to these 10 observations, can you explain a little bit and why is it important?
Again, referring to our colleagues who are on the call, I think all of you probably have observations or rules of thumb or points of fear when dealing with any particular financial service activity in any particular jurisdiction. Hence, in the case of restructuring in the emerging markets, what Tim and I attempted to do in the book was to take our experiences and those of others with whom we consulted and come up with a set of challenges, characteristics, or gremlins, as we would like to call them, which touch on what first are the drivers of restructuring or debt distress situations. Secondly, when one arises, what is the initial condition? And then thirdly, how the process is affected. And so our 10 observations, and everyone has their own, were in the first instance that emerging markets are generally characterized by what we'll call more volatile economic activity, where recession, vulnerability to financial crises, other imbalances, and hence we all know whether it's Latin America in the 1980s, Asia in the 1990s, etc. The external macroeconomic world and just shocks, sunspot type shocks that go across are important. Secondly, that law, regulatory, and governance issues are a little bit less well developed, and then they create problems that are both at the idiosyncratic level but also systemic level to the economy as a whole. So that would be what drives restructuring. Second, in terms of the outbreak, we observed two things. The first would be that very often when emerging market restructurings happen, they are more severe when they're first discovered, whether it's fraud or the impact of a sudden stop in capital flows or whatever. Now, it doesn't say you don't have sudden disasters in the advanced economies, but generally speaking, we find them more in the emerging markets. Second in this category would be a tendency to do collateralized lending, secured lending, to the point where some commentators have referred to banks in the markets there, in some cases, as being kind of glorified pawn shops where they lend on the basis of collateral. If the borrower gets into debt distress, without a moment's thought, they accelerate, and then it brings the company down, which otherwise rescued. The last category would be the process, and this touches on things such as, is there a mature and well-functioning judicial restructuring environment? Secondly, is there a tradition of consensual multi-party restructurings, Insol, and things like that? Are there defense mechanisms for all stakeholders? And then a fourth one was the role, as Tim referred to, the question of predatory political pressures or corruption in societies. And then the last of the 10 touch on things such as can you have a well-functioning process of restructuring, do you have access to what we'll call the best of breed in terms of debtor and possession financing, pre-packs, cram downs, and the like.
Mm-hmm.
And so we established those 10.
Yeah.
And taking those 10, we demonstrate in the book a number of ways through some very short case studies. We actually have a parable about two travelers, which we think in a kind of a very simplified way helps you understand the differences. And then lastly, we have 4 case studies. We have 2 financial institutions and 2 corporates, and in each of the 4, we weave in these, not all, but most of the 10 observations, and then we link the events in the case studies to specific institutional aspects as we develop earlier in the book, and hence demonstrate, we hope, that the pivotal role of underdeveloped institutions, not simply in economic instability and potentially higher rates of default or not, but certainly in terms of challenges in the restructuring process, which could translate into higher loss given default levels.
Just wanted to mention one thing that Richard was big on was this use of parables for stories.
Yeah.
If you look back at human history, how are lessons taught? They're taught by telling stories to our children, fairy tales. Every fairy tale, every story has a greater meaning. And it's one thing for you to write a cold textbook that says, this is the meaning, and then hope that your reader's going to remember it. But what Richard's idea with the first book was the fox and the stork in this parable that we've used, and then the use of narrative for our case studies. And we've continued with that in the parable of Charles and Mayling, our 2 drivers. And we think that using that type of story helps to bring it to the reader, to bring a message home, and also should hopefully make it fun to read and enjoyable. So we would hope that they would look at both of our books and glean something more, and perhaps not fall asleep quite as quickly.
Yeah, it sounds like, it sounds to me like, because the topic is so complex, it's not black and white, so it's also, I think, using this way of narrative and this way of storytelling. It also seems to match very well, because the book is not supposed to be prescriptive, and also you're not what you have to do, but also you provoke the thinking of people.
No, I think so. My impression from the first book was that many of my colleagues in the restructuring community could have just as easily written the book, and I think that the reason for that is that each of us over our time in workouts develop thoughts, rules, approaches, and I think if the book does, as the first one, does nothing more than prompt questioning, then it will have succeeded.
Yeah. And a little bit, because you were both referring to the several times to the Insol principles, and looking at the institutional framework and the challenges in restructuring. And maybe, Tim, do you think could you give some color of why these Insol principles are so important?
Well, let's go back to North and institutions, informal and formal. Insol is a set of informal institutions. It's not a law. It has no mandatory or prescriptive character. It's a set of ideas and principles that came out of what they called the London approach, and then developed into something called Insol 1 and now Insol 2. And basically it says, hey guys, let's get around the table. Let's take a breathing moment. And this is something which is relevant to real life. You can't actually take a good decision in a heated moment under pressure. And so the basic principle of Insol is to enter into a standstill when there's no evidence of wrongdoing or fraud, when there's still trust around the table amongst the players. And the idea is to sit down. No one's going to enforce. We're going to look at this. We're going to do some due diligence on this borrower. We're going to see if there's a going concern or worst, an orderly wind down possibility, and then to come to terms in defining what that path forward would be. And in emerging markets, ironically, we're in an environment where Insol principles are so critical. We found in discussing these with many of dozens of our colleagues in emerging markets that they're very, unfortunately, they're not very well known. So that's another reason of the book, to promote the Insol principles, particularly in emerging markets where you find weak judicial restructuring regimes, parallel universes where the law in the books does not operate the way it's intended, and where you have to basically create your own microcosm of stakeholders who are going to take matters into their own hands and deal with things in a way which presents the best possible outcome for everyone.
Yeah, and Oleg, your team has had a restructuring recently where Insol was not understood in the market, and the local bank or banks were unwilling to engage in this kind of process. The borrower was unwilling to because they simply weren't aware of the logic of it, and it's ended up in liquidation. And so I think the ability to have this period of quiescence when people can sit down and talk calmly is the most important aspect. I think you and I have the opportunity to speak to some very extraordinarily talented colleagues at the World Bank who have been advising governments on this whole issue, and I'm putting words in their mouth. I think the single best outcome would be if there was a prioritization, when possible, of consensual multi-party restructuring, which can keep more companies as going concerns and minimize losses for all stakeholders.
And in some emerging markets, the legislature has actually started to bake into the insolvency law these pre-restructuring regimes where the legislature tells people, please consider and try to implement a consensual restructuring where possible. And that works because in many markets, like the countries of the former Soviet Union, people don't have the wherewithal to come to that of their own accord, and they often need to see that in the law to give them a prompt to apply it.
But is this Insol principles so valuable? Yeah, because they help really preserve, to recreate the value. Yeah, and why they're not so widely used in the emerging markets? Do you have any idea? Because I mean, actually, everybody would benefit. Yeah,
$4 million. I think tradition, self-interest, selfishness, expediency. If you have 150% asset cover and you think you're going to get most of that collateral monetized, why bother?
You could also look at it a little more dimly in that the political and economic elite of an emerging market are often more favorably treated in the absence of an Insol application.
Yeah. So it sounds a little bit like not seeing the big picture, because I mean, if the cake is bigger, actually everybody would benefit more. What you say is like a little bit, I would say maybe some stubbornness, because and also lack of flexibility in the mindset of some lenders.
The bigger the pie, the bigger the slice.
Exactly. Beautiful. Yeah. Thank you very much.
Cheers.
Yeah. I think Rachel now.
Yeah, hello. I'm coming back to present a couple of questions from the audience, but thank you for your insights so far. One is, what is the role of multilateral and bilateral financial institutions? So perhaps you could address that for us.
If we could ask for some elaboration, when we're speaking of bilateral and multilaterals, are we talking about public sector development finance institutions and the Washington, D.C. based World Bank IMF group?
Most likely.
I think you could.
Yeah, okay. Just to be clear. You know, those kinds of institutions, well, if you take the bilaterals and then and the multilaterals being the IFC specifically and the regional development banks, they are lenders like we are. Admittedly, they have different what we'll call economic characteristics and drivers. When they are involved in a restructuring, the hope and expectation is that they will, you know, conduct themselves according to their role of a catalytic source of capital and a stabilizing influence on the market. And so, in our experience, certain of them have been outstanding in terms of guiding the process and allowing lenders who might be a bit more timid and hence less supportive to find their way clear. So I think the role is essential.
If I could just add to that, in addition to that role of lending, I think the DFIs play, both bilaterals and multilaterals, play a critical role in promoting legal reform in the insolvency world. Firstly, like the World Bank, like EBRD and others who have looked very critically at insolvency frameworks, they play a very important role in assessing those frameworks and then promoting the reform of those frameworks at the country level. They also do incredible work in the field of corporate governance. For example, if you look at EBRD's corporate governance assessments on country by country basis.
So, and I would add the World Bank as well. A quick perusal of their website will demonstrate the scope and depth and quality of the work that they do.
And just to plug the World Bank again, the work that the World Bank has done in promoting consensual restructuring is also critical. Their toolkit for restructuring has been very helpful, and it's also been a source of inspiration for Richard.
No, some of their work was extraordinarily insightful.
Thank you. That question was from Mark, and now we have a question from Alicio, who's asking, the question is, in your experience and at what extent a bad governance is the key driver leading to restructuring, maybe beyond macro aspects, and how relevant is governance for this successful restructuring case?
Well, I'll start. I think bad governance is a material driver of debt distress in many instances. So that plays a role, and oftentimes if the lack of appropriate corporate governance, broadly writ, drove the debt distress, it becomes a challenge in the restructuring. And I think Oleg, recent times, has had to, in particular, address those kinds of issues. Hence, in a restructuring, oftentimes you're not simply engaging in financial engineering, but also in governance reform. In certain of our case studies, we stress that, where a sustainable outcome is not simply addressing a liquidity shortfall or an insolvency condition, but also addressing via the corporate governance activity, if you will, the transmission channels by which a debt distress situation has arisen. So it's extraordinarily important. In closing, you can fix a financial problem on Monday, but if you don't fix corporate governance, you might be back there on Friday.
Maybe just to add to that also, because I mean, usually in restructuring, you don't have simple answers. because questions are very often very complex and many nuances that they'll provide. But I think also if we look at our restructuring cases in so many years, which we have managed, actually I think it's maybe one of the few exceptions where I would be willing to say that corporate governance is usually the key reason for distress situation, because even if you have macroeconomic shock or lack of liquidity, the question is how corporate governance of the borrower has responded to that. Yeah, because not everybody is hit in the same way. So I also would agree with you, Richard. This is, a key topic actually in the distress situation: quality of corporate governance.
No, and over the years, by sitting on boards, you see that.
Yeah.
You can anticipate how a particular decision or a lack of a decision can implement a policy or procedure, or to engage in enterprise risk management, or monitor and remediate those kinds of issues, would ultimately lead to a condition where over leverage would occur, that investment decision making, what have you.
Yeah.
Thank you. We also have a question from Dimitri with the following question. In his work with CEE, it appears to me that the legislation environment, sorry, I've lost the legislate varies from country to country and is not always lender helpful or very friendly.
Sorry, could you repeat the question? I didn't quite get it.
Yeah, in your experience, sorry. So during his work in CEE, it appears to me that the legislation environment varies from country to country and is not always lender helpful. What, in your opinion, helps?
No, I would absolutely agree with that, Dimitri. The point that we've made time and again in our book is that not every emerging market is the same, and particularly in the CEE or Central Eastern European field, you will see that the law differs from country to country. There are many similarities. For example, most of the civil law systems in the former Soviet Union, they're all based ultimately on the Roman Civil Code, which then morphed into the codes of the 15 Soviet republics, which then, following 1991 breakup, you then saw them each individually develop. So there is a lot of difference between CEE countries, some similarities within the former Soviet bloc as well. But it's not just the laws on the book. Again, it's whether the players are willing to accept, to understand, and to abide by those laws and to apply them impartially. That's unfortunately not all the case. The influence of, for example, corruption on the way in which those laws are applied could differ greatly. So you see some countries, for example, Georgia, or recently Ukraine, which have made good faith efforts to tackle corruption, and whereas other countries are not only lagging, but now they're going backwards in time, and the way in which that influence of corruption, state capture affects the manner in which the laws are interpreted.
Thank you. And I have a question from Ulvia, and I'm sure you've got some experience, but have there been failures to reach an agreement amongst creditors for a workout? And what lessons have you learned from these cases?
Yeah, not all stories have happy endings. Sometimes you want a handkerchief or a tissue. It's a very good question. Quote to Tim, we only have 45 minutes. Sometimes it's simply that the size of the hole is too big to fill. Right? Sometimes it would be possible to fill it, but you can't get the stakeholders to cooperate.
Yeah.
Sometimes bad actors step in and move the transaction in a direction that is not in people's interest in the deal. So it happens all the time. And the only other comment I would make is that personalities matter enormously. And since chapter 10 of our book, we try to do an overlay of everything we've got already to talk more about negotiating personality types.
Yeah.
And I think for everyone on the call, you'll all recognize how a well-structured steering committee arrangement with individuals who are able to manage the diverse personalities matters, because sometimes a successful outcome to a restructuring is the least worst outcome. And sometimes you spend more time engaged in behavioral psychology than you do in financial engineering.
I'm going to take a second to plug responsibility in their restructuring team here, because you guys do a fantastic job. I mean, when I look at the institutions, the clients that I work with, all great clients, a lot of fun, but when I work with responsibility with Oleg and Richard, I see that it's not only, talking the talk, but they actually walk it as well. And the amount of investment that responsibility is put into building a truly remarkable team in the way you lead your restructurings is really, it's unique. So do we see deals falter and fall apart? Yes, very frequently out in the real world. Does that happen with responsibility? Fortunately, I think a little bit less, but I would also say that it depends upon the ability of the steering committee to put the selfish institutional interests aside and to look at the interests of the group as a whole, all stakeholders, and find, as Richard says, the least bad outcome for all. You underscore the word for all, because it's that vision of seeing how you can get from point A to point Z, and the work that you have to do in that process of dealing with unanticipated surprises as they come along, which are many in the emerging markets, and then dealing with holdouts in a way which is effective and puts aside the immediate emotional response that you might have to someone saying that they're going to pull the plug or enforce their security, but to find a solution in each case which is appropriate for that particular case. So kudos to both of you guys and to your team. Very well done.
I mean, thanks. Then I will also to add to that actually every consensual arrangement requires engagement to many compromises. But I think it's also very important that not to lose a big picture behind these compromises, because usually it's better to have this consensual arrangement, but there are also certain like lines or red lines. If you go into too many compromises, you can crush the borrower so much that going concern is not possible anymore. So I think it's very important on one side to listen, to engage, to agree, but also to understand that sometimes it can be too much. And even if somebody who is redeemable can be killed. Yes,
right. And in the background to a consensual restructuring exercise needs to be a effective judicial process that allows cram downs, etc.
Yeah.
That threat, not to take the company into liquidation, but to force reasonableness on otherwise unreasonable lenders or borrowers for that, to get something done.
Yeah.
And so the idea of nirvana would be having an Insol approach, but within the background capacity to help people get to the right answer.
Yeah.
I think we have time for one more, and I think really good question from our very engaged audience, and thank you for all the questions coming in. From Arjun, how, if you're a lender and you enter a lending meeting in a restructuring case, but you're a small lender, but the exposure for you is high, what strategy would you employ to secure your interests when you're amongst other a large lenders group? This is specific to the emerging markets.
Could I make a suggestion? Get on the steering committee.
I knew you were going to say that.
Just don't wait for someone else to look after you. Get on the steering. You'll get a lot better recovery.
Yeah. I was going to say the same thing. It's involvement.
Yeah.
And also being proactive approach to your participation to help drive the process.
Yeah.
I think that's all we've got time for, but clearly on the poll, what came out is people feel that navigating local institutional frameworks is the biggest challenge. I wonder if you would all like to say one last word on your top tip, maybe the top thing you could suggest to navigating local institutional frameworks. Thanks.
To start, to the extent that you could, is to build into your financing structure, wherever you are on the capital structure, the particular pitfalls in a jurisdiction, so that you have baked in your solutions to the extent you can.
I would say humility and a willingness to be open and to learn.
Now, my thought maybe to add to that, say we cannot escape working with emerging markets with a weak institutional framework. But experience shows also very often, if you manage to establish very strong relationship to the borrower, to other creditors, to some extent can also compensate for this weak institutional. So relationship, particularly where the rule of law and court system is weak, matters, I think, even much more than the advanced economy.
And with that, I think it's time we thank our panelists. I know we could have a lot longer discussion. Thanks to Oleg for moderating, from Tim, from Richard. Really appreciate you coming together and having this discussion. We will be sending out this webinar via video, so please feel free to share it further. And look out on LinkedIn for further webinars, which will be running in the coming months. With that, thank you all for joining, and I wish you all a very nice rest of the day. Thank you.
Thank you.